If you invest in financial markets, you need to hear what I'm about to tell you. For the past 15 years, U.S. stocks and the U.S. dollar have been the best investments globally, but that trend is ending, and soon. In the year 2020, commodities and interest rates began supercycle advances that are still in their early stages, and that means that the best investments over the next decade or longer will be found not in Silicon Valley, but in emerging markets. Hi, my name is Mark Galasiewski, and for the past 16 years, I've monitored financial market trends in Asia and emerging markets through the lens of the Elliott Wave principle, and that experience has given me a unique perspective on the role that commodities play in the global economy. For example, it allowed me to correctly predict in February 2020 the end of the 2008 to 2020 bear market in the Bloomberg Commodity Index to within 2% of its price low 2 months later, and then to correctly forecast enormous upside for commodities, price inflation, and interest rates, as I put it in September 2020, when the yield on U.S. 10-year government bonds was 0.72%. While the inflationary boom since that time has caught most of the world off guard, most people still seem to see it as an aberration from the long disinflationary trend that preceded it, a one-off byproduct of the COVID-19 pandemic. If only the Fed will continue to lower interest rates, so the conventional wisdom goes, then the trend toward lower rates of inflation will resume, and the good times promised by artificial intelligence and other technological innovations will continue. However, long-term patterns in commodities and interest rates beg to differ with that line of thinking. As in the 1970s, the material world is again rearing its ugly head, and most people are completely unprepared for the extent of the long-term inflationary trend that began in 2020. I can't emphasize this point enough, so I urge you to give me several minutes of your time to let me give you a framework for understanding the major financial and macroeconomic changes that are likely to define the next decade or longer. It will help you not only to survive, but even to thrive in the new financial environment ahead. The era of intangible assets is in its final stages, and the era of tangible assets has already begun. What's more, the transition between the two eras is about to accelerate, probably in early 2025. So you need to understand it now while there's still time to take action. The first thing you need to know is that the global Infotech sector, represented by America's NASDAQ 100 index, is approaching the end of a five-wave advance from the year 2002. The cryptocurrency sector, which was spawned by the Infotech sector toward the end of the global financial crisis of 2008, has ebbed and flowed with Infotech since that time. The leading cryptocurrency, Bitcoin, which accounts for about 60% of the total market cap of all cryptocurrencies, is approaching the end of a five-wave advance from 2008 in line with the five-wave advance in the NASDAQ 100. The parallel trends in NASDAQ stocks and Bitcoin are not a coincidence. They are a byproduct of the same animal spirits that have made Infotech the dominant asset class of the past several decades. Once they end their five-wave advances, both asset classes will begin severe and possibly long bear markets. As the intangible or Infotech assets enter the final years of their era of dominance, they have begun to pass the baton to intangible or material assets. From 1980 to 2020, the Bloomberg Commodity Index traced out a three-wave corrective pattern that is similar in form to the smaller corrective pattern it traced out from 1963 to 1968. Just as that smaller three-wave pattern was a second wave within the larger five-wave advance that lasted until 1980, the three-wave pattern from 1980 to 2020 is probably also a second wave, although in this case at 1 degree of magnitude larger. That means that the commodity bull market that began in 2020 is a large third-wave advance that could last as long as a few decades and will likely be paralleled by rising interest rates. The example of the 1970s shows that while commodities and interest rates did not always move in lockstep with each other, their bull markets did parallel each other, and we can see that relationship already repeating during the current bull markets as well. Now you can understand why I was so bullish on commodities and interest rates in 2020. But that forecast was not just a short-term call, it was a multi-decade call. The dramatic rise in the prices of almost everything since 2020 is an early expression of this new era, which has only just begun. The recent rise of gold, which is now the leading material asset, marks it as the new Bitcoin. Conventional analysts have tried to make sense of the relationship between gold and Bitcoin since the rise of cryptocurrencies 15 years ago. But from my perspective, the two markets are simply the leaders of their asset classes, tangible and intangible. The metals breakout in early 2024 from a 13-year net sideways trend is as significant for materials and materials producers as Bitcoin's initial advance from 2009 and the Nasdaq's 2012 breakout were for Infotech. Therefore, gold's breakout is also a bullish sign for emerging markets, which, like commodities, underperformed Infotech after 2011. In fact, gold has ebbed and flowed with the iShares MSCI Emerging Markets ETF since that time. My wave counts indicate that gold, materials, and emerging markets should generally continue to advance together for years to come. My long-term wave count for the MSCI Emerging Markets Index shows it to be ending a long sideways trend near the lower line of its long-term trend channel. Deutsche Bank's total return index of emerging market currencies is at a similar juncture. If my wave counts are correct, both emerging market asset classes are about to begin sustained advances above their long-term support lines, as they did in this century's first decade. For global investors, the burgeoning long-term uptrend in emerging markets offers extraordinary opportunities. That's especially true because emerging markets are likely to offer far better performance than U.S. stocks for many years, as they have done at least a few times in the past. This graph is the MSCI Emerging Markets Index and an earlier index of emerging market stocks divided by the S&P 500 index. The long advances in the ratio from 1967 to 1994 and from 1999 to 2010 show that emerging markets have a long history of providing world-beating returns. At present, the ratio is now at its lowest level in more than half a century. While the ratio's low value by itself does not guarantee it will turn up, I believe I have a means of timing the next upturn. It turns out that the performance of the U.S. stock market versus emerging market stocks is related to the performance of the U.S. dollar versus foreign currencies. This chart shows that when the U.S. dollar index is in a rising trend, as it has been for the past 14 years, U.S. stocks tend to outperform emerging market stocks. That means that to broadly identify the start of the next major period of emerging market outperformance, one simply has to identify the end of the bull market from 2008 in the U.S. dollar. Let's do that now. This chart shows that the U.S. dollar index, which represents the performance of the dollar versus a basket of developed nation currencies, ended a 5-wave advance from 2008 at the index's 2022 high. That high did not mark the start of EM outperformance, and the bottom graph may explain why. Deutsche Bank's spot index of emerging market currencies versus the U.S. dollar has continued declining, reflecting the relative weakness of emerging market assets. But the index looks likely to end a 5-wave decline around early 2025. About which time emerging market stocks may begin another era of outperformance. New lows in the EM index look likely to coincide with the lower high in the U.S. dollar index, just the type of divergence between market sectors that sometimes occurs at major turns. In October this year, The Economist called America's economy the envy of the world while featuring a rocketing roll of U.S. dollar notes on its cover. It was an excellent choice of symbol from my perspective because strength in the U.S. dollar is the key to understanding the outperformance of U.S. assets compared to others in the world. However, my wave counts show that the magazine's cover is likely best viewed from a contrarian perspective. That is, it is probably indicating a peak in the U.S. dollar versus other currencies and therefore the start of a period of underperformance by U.S. stocks. What emerging market assets might be able to outperform U.S. assets over a sustained period? Well, many emerging markets feature cheap currencies and relatively low stock market valuations. But the most obvious candidate is China, whose stocks recently traded at record low price-to-book ratios and whose currency is at the core of Deutsche Bank's EM currency indexes. My wave counts show that the Shanghai Composite Index ended its bear market in early 2024 and has since begun to trace out a series of first and second waves in a new bull market. Meanwhile, China's currency looks set to soon end its bear market from 2014 in line with other emerging market currencies. Notice that I've inverted the graph of the yuan to show it weakening against the U.S. dollar. Where might China's currency go from here, and why might Chinese stocks provide some of the best global returns during the next era of emerging market outperformance? My answer to that question is shown in this chart. It shows that from an Elliott Wave perspective, the yuan is in the same position as the Japanese yen in the early 1980s. That is, ending a large second wave and about to strengthen dramatically against the U.S. dollar in a third wave. The historical parallels are compelling. In the early 1980s, Japan was the world's dominant manufacturer, and its currency and stock market would go on to outperform their peers by far over the next several years. Yet it would have been difficult to imagine such an outcome in 1982 when the global economy was mired in recession and the yen had spent the prior 4 years weakening against the U.S. dollar. But in financial markets, as with other areas of social activity, dramatic reversals occur commonly enough that any credible observer must take such possibilities seriously. Therefore, astute investors should consider Chinese assets at present. For anyone who is concerned about political risks, many emerging markets other than China should also provide excellent opportunities. So I think you can understand my excitement now about the long-term prospects for emerging markets around the start of 2025. There will probably be a highly volatile transition period before emerging markets really begin a sustained uptrend. For example, the last two bottoms in the emerging markets S&P 500 ratio around the current level occurred in mid-1967 and January 1999, after which emerging market stocks led U.S. stocks higher for more than a year. But thereafter, global stocks fell into a severe bear market before emerging markets really began to outperform. So the next few years may follow a similar pattern of volatility. But emerging market stocks, commodity producers, and commodities themselves, especially the sector leader gold, will likely provide the best defense against the erosion of wealth that will inevitably occur as the prices of everything continue to rise year after year. The game is about to change because the dominant financial trend is about to shift from intangible assets to tangible assets, as it seems to do every few decades. But as an individual investor, you have the opportunity to use your knowledge of these historical patterns to survive and even thrive while the U.S. stock market and the U.S. dollar stagnate. To learn more about this strategy and to join me on this intellectual and investment adventure, consider subscribing to my publication, The Asian Pacific Financial Forecast, or its parent publication, Global Market Perspective.